What is up, YouTube? What is up? We are back, part two of the most powerful man on Wall Street. Let's get it.
They decided to step into the thriving industry of private equity.
We came up with a good strategic plan to do advisory work to pay the rent, to go into the buyout business because it looked like a pretty easy way, frankly, to make money in the mid-'80s.
Steve Schwarzman is a risk-averse entrepreneur. He wanted to have a steady stream of income first, before building the greatest private equity in the world.
This idea that entrepreneurs are risk takers is complete BS. They're risk takers from the perspective of people who are watching them, not from them themselves. People who are entrepreneurs just see the same facts differently, or they
I want to read that
actually
book,
obtain.
Stephen Schwartz, What It Takes. Writing that down. Stephen Schwarzman, What It Takes. Okay. I will look for that book later, and I will read it.
Different facts.
Putting down $200,000 each, they opened their business at the Sea Grand building just north of Grand Central Station. Both Schwarzman and Peterson were highly respected professionals in finance, possessing wide connections. Raising capital for their private equity fund should be easy for them. At least that's what they thought.
We sent 600 letters out to people, announced our new business, and I expected the phone to be ringing.
So I don't know how often you like to be rejected, but try it that many times. My math skills aren't that good, but it's got to be somewhere around 450 something rejections.
Fortunately, there was enough cash flow from their consulting business to keep them going. More determined than ever, Steve Schwarzman vowed that he would never stop until he raises $1 billion for his company. Raising capital is a confidence game. Don't overestimate how smart these investors are, because sometimes they exhibit hurt behavior. I think that is why Bernard Madoff was able to raise so much money from these so-called sophisticated investors. After endured countless rejections, Steve Schwarzman finally raised $100 million from an insurance company, Prudential.
There with their chief investment officer, Garnett Keith. I'd never met him before. I was doing my presentation of private equity fund and getting a piece of our fees from our M&A business, so we're starting a merchant bank. And he looks over to me and he says, "That's very interesting. Why don't you put me down for $100 million?" And I couldn't believe what I was hearing, because at that time, the Prudential was the largest investor and the most prestigious investor in the world in private equity. And $100 million in 1986 for a fund that was first-time fund, and two people never made an investment. This was like getting $500 million.
Once the first investor put down $100 million, it instills a great deal of confidence to other potential investors.
We ended up raising the biggest first-time fund in history with two people who'd never made an investment just by force of will. So it does show you that force of will counts. It counts.
With that willpower, they raised a total of $1 billion to start Blackstone. Trusted with such a large amount of money, Steve Schwarzman knows failure is not an option. His first investment is going to be the deal breaker. His years of experience has shown him that high risks don't always equal to high rewards. He wanted high rewards without the risk. Right away, he found a great company to buy.
Listen up right here. The art of
U.S.
deal.
Steel was the company created in 1901 by J.P. Morgan when he bought the Carnegie Steel from Andrew Carnegie. Steel production was vulnerable to the sharp rises and falls in commodity prices and fluctuating demand from customers. By 1987, a labor strike paralyzed its plants, and Carl Icahn, a corporate raider, has bought enough shares to launch a proxy action for a hostile takeover. To raise the green mail money, they plan to sell the railroads and barges, divesting them into a separate company. This potential new company is a great candidate for a leveraged buyout. To make an LBO work, Blackstone has to borrow a large amount of money to finance the deal. Since they were a new player in town, no major banks would want to lend them money. But there was one bank that decided to take a bet with Blackstone.
New York has always had more different kinds of people than any place else, but they have one similarity. They all think there aren't enough hours in the day. That's why in 1969, Chemical introduced the first cash machine. And now we've brought 24-hour banking home with people you can call anytime, any day.
It turned out to be the best thing to happen to Blackstone. This chemical bank will later grow to be an unstoppable force in finance, eventually devouring banks like Chase Manhattan. Subsequently, Blackstone put in $13.4 million in equity, while borrowed $636.6 million from chemical banks and the bond market. Blackstone's first deal turned out to be a great success. As predicted, the steel market recovered, and the transport business was booming. Blackstone's investment improved the company's cash flow, and in 4 years, their equity quadrupled. By the time they sold the business in 2003, this one investment achieved an annualized return of 130%. However, finance is a fragile business. One mistake can spell the end. Edgecom, based in Philadelphia, another steel plant, manufactures parts for cars, trucks, and airplanes. Once again, Steve Schwarzman made a bold bet in the company with around $300 million. A month after the deal was closed, the steel price started tumbling down, and Edgecom was imploding.
This was truly terrible. This was our third deal, and I had one of our partners. We had no processes. I had never made an investment before. One partner thought this deal was a good thing, and another one heard we were looking at it, and he came in to see me. He said it was going to go bankrupt because it was just making inventory profits disguised as real profits, and that when steel distribution business, when steel prices went down, as much as we were earning, we would lose that and more on the way down, and the company would go bankrupt. And within 6 months, we couldn't pay our interest on the debt, and ultimately, we lost all of our money. And this was beyond traumatic. I don't like failure. I'm not used to it. We all have it.
Humiliated, Steve Schwarzman vows to never make the same mistakes again. He was going to build a robust decision-making system that prevents failures like this.
This is not a normal thing. And what we do when we fail is we spend enormous time thinking through what did we do wrong. Failure is how you manage failure is very important. And some people manage failure by making pretend it didn't happen. And they just go about their jobs and people don't pay attention. Well, we lost money on that.
Or pretending things did happen.
That one. I don't believe in that. I like to learn.
After that, Blackstone rarely had an investment that lost money. There's an argument saying that finance doesn't really create value. It's just people exchanging money. But I do believe that Blackstone genuinely created value for the companies by offering capitals, expertise, talents, or management. The incredible track record has fueled the unstoppable growth of Blackstone. To get even more prominent, they decided to expand into the real estate market. However, by 2006, Steve Schwarzman sensed a storm is coming.
Goldman Sachs, Bear Stearns, Lehman Brothers, Merrill Lynch were all in on this. The subprime lending alone increased from $30 billion a year.
They all are all in on it. On every type of investment decision or anything like that decisions are made based on BlackRock and Vanguard.
In funding to over $600 billion a year.
They own everything.
Blackstone was among the participants of this real estate boom, but they had an insight that
they own at least 10 to 15% of every single company. You can Google that. You can Yahoo Finance it. It'll literally tell you every shareholder in a stock on Yahoo Finance. You go to Google, 10% of it is owned by BlackRock. You go to Nike, 10% of it is owned by BlackRock. You go to American Airlines flight company, 12% is owned by BlackRock and Vanguard. So they own everything.
put them one step ahead of the market. Public companies containing lots of real estate properties were frequently valued at less than some of their parts. Blackstone could take the real estates off their hands, fix them up, and resell to other buyers. By this time, Blackstone has established itself as a force to fear in the private equity business. With size comes competition. While eyeing his next game-changing real estate deal, Steve Schwarzman realized he must act quicker than before because there are more competitions now. Equity Office was a real estate investment company that owns hundreds of office properties comprising tens of millions of square feet. On November 2, 2006, they offered a premium of 8.5% over the market price, and EOP opened their books to Blackstone. This move...
Speaking of REITs, real estate investment trusts, if anybody knows how to invest in those or knows any knowledge, leave a comment down below. I'm trying to learn how to invest in some REITs, for the future. Or it's because I want to get into real estate, but I don't want to own any actual properties or like any single rental properties, right? I want to own commercial properties or land properties along those lines. I know that you can buy REITs and invest in those. But yeah, leave a comment down below if you have any knowledge on that. Get with me or I'll get with you and we can work something out.
And EOP opened their books to Blackstone. This move attracted a bunch of competitors in the industry to join the bid. Not willing to lose the bid, Steve Schwarzman raised their offer to 9% at $52 a share. To his surprise, Vornado, a real estate investment company, outbidded Blackstone. Schwarzman was furious and raised his bid to $55.5, 24% higher.
I don't know why, but this dude reminds me of the old guy that played Green Goblin. He looks like he's about to bust out his Green Goblin suit.
Than a market price. And that is their final offer, which is all cash, while his main competitor Vornado offered part cash and part stock. This has sealed the deal for Blackstone. They won. What Steve Schwarzman did next shocked everyone. Realizing that he may have overpaid, putting his investment at a risky level, Schwarzman decided he will sell half the company to take immediate profit.
Since we were in market top for real estate, so just buying $39 billion of real estate, I thought was dangerous. because you had to pay a pretty good price to get it because it was competitive. So as soon as we decided we were going to actually raise our price enough to be the winner, there were 2 or 3 of us sitting around saying, this deal is potentially dangerous. We've got to reduce the leverage, and we've got to take advantage of the crazy prices that people are paying. So we decided to sell half of what we bought the same day we bought it. So when I told people that, they just sort of looked at me and said, the same day? I said, I don't want to take any risk.
Closing the largest real estate deal, Steve Schwarzman turned 60 years old in 2006. However, instead of thinking about retirement, Steve Schwarzman was thinking about his next big move. By 2007, the market was still hot, but Schwarzman sensed there's a storm coming. Maybe there's still a chance for a massive expansion of assets before the storm hits. That is to go public. On July 24th, 2007, Blackstone raised $7 billion, the second largest IPO after Google. By 2021, at the age of 74, Steve Schwarzman is still the chairman and CEO of the Blackstone Group, which is now more massive than what Lehman ever was.
Steve Schwarzman, he's the new king of the world. Right. Leonardo DiCaprio will play him in the movie. The report today says they have $78.7 billion under management.
Mr.
What movie is that? The Wolf of Wall Street?
Schwartzman's firm has had a return on private equity investments of.
Hey, if you know any Wall Street movies or any type of investing movies or investor movies or whatever, leave a comment down below. Maybe we can go over some more documentaries or any investor type videos.
23% a year on average for the last 20 years. In the real estate group at Blackstone, they've had 30% a year for the last 15 years. And this is after fees.
Once anybody decides to do something, particularly with their life,
Crazy jump.
it's a must-do. I mean, you can't fail. And you try and think really carefully before you do something. And if it's well conceived and it's not working, that just means you have to move it around. Or, you know, maybe you're too early, the world isn't ready for you. And so you just suck it up and go back again. And you can never give up once you make that commitment.
All right. That was a good documentary. Got to learn a little bit about Steve Schwarzman, the most powerful man on Wall Street. You guys learned anything or have any insight, leave a comment down below. Also, leave a comment down below if you have any other documentaries or any investors that you would like me to react to. JP Morgan, BlackRock, Vanguard, Larry Finks, any of those, leave a comment down below. But have fun making this video. I hope you guys have a good rest of your week. I'll catch you guys in the next one. Peace out.